The current market is in a bit of a weird state, with most large cap stocks being pretty expensive, especially in the technology sector. Despite this, there are still some good stocks that I think are at pretty decent valuations that you can add to your portfolio right now. That is why, in this video, I will go over 7 of these stocks and why I think that each of them might be a buy at current levels. So let's get right into it. Before we start this video, make sure to like and subscribe if you're new to the channel because I will be posting dividend stock videos just like this one every few days. The first stock on this list is the Lowe's company, ticker LOW. This company is a retail company that specializes in home improvement. They have over 2,000 locations and it is one of the biggest companies in their sector with a market cap of well over $100 billion. Because Lowe's is a retail chain, they have been hurt by weakening conditions in the retail sector, especially in regards to theft. In addition, generally poor economic conditions as well as a decline in the home improvement market has dropped Lowe's to 27 below its all-time high and 4% down year to date despite its initial bump. This has left Lowe's with a pretty respectable P ratio of around 18, which is solid for the company. In addition, the company currently yields just around 2.3%, which isn't that bad. This dividend, however, is even better when you consider some of the stats. The company has a 10-year dividend CAGR of 20.47%, which is insanity, and the most recent increase was another 23.19%, which is again just crazy. The stock has also increased this dividend consecutively for 49 years, meaning it's just about to become a dividend king. The payout ratio is also pretty low too, so for dividend growth, this stock is about as good as it gets in the entire market, which is why it is the first stock in this video. The second stock on this list is definitely a little different to the last one, but is the Altria Group, ticker MO. This company is notorious for its extremely high dividend yield and the fact that it is a dividend king. The stock is down big from its all-time highs due to a few reasons though. The first reason is that cigarette sales are dropping in the United States, which is definitely bad news for the company considering it specializes specifically in the US. In addition, their minority stake in e-cigarette company Juul went bust and it resulted in Altria losing billions of dollars. This all sounds bad, but I assure you there are some good reasons to invest. Firstly, as I mentioned earlier, the stock has a yield of over 9% currently. This is extremely high and they are still growing this dividend. The board currently plans on increasing the dividend by around 5% annually up until 2028. This doesn't mean after 2028 they will stop increasing the dividend, but that is basically what they can promise for now. In addition, they are going back into the e-cig market, but this time with a bit more of a sound strategy. They've recently fully acquired Enjoy, an e-cig company, for a few $billion. This will probably pay off better than Juul did because firstly, Altria has complete control over this company, which is good, and also Enjoy has already been approved by the FDA, which was the major reason Juul failed. Overall, Altria is one of the best high-yielding stocks that you can get out there, and it is priced very fairly, especially if you can get a share for under $42. Now, the third stock on this list is Mondelez, ticker MDLZ. This company is an American food, confectionery, beverage, and snack company based out of Chicago. This stock has a fantastic brand portfolio that I am showing on screen right now, and as you can see, they have some pretty top-notch brands underneath their name, especially in the snack and candy section. This company uses these strong brand names to drive up revenue, and it has shown this with the stock up 60% in the last 5 years, which is easily market beating. Despite this, the stock is down nearly 20% from all-time highs, and the stock is also priced at just above a 21 PE, which seems pretty reasonable for a stock like this. The stock, as well, has a dividend that pays 2.65%. This dividend has a 10-year CAGR of 11.54%, and the most recent hike was 10% on the dot, which is a nice bonus. Overall, out of all the snack companies out there, this one might be my favorite, even more than Hershey, because I think their brands are simply top-notch in their respective fields. The fourth stock that I'm going to go over in this video is Pepsi, ticker PEP. This stock, like Mondelez, has been beaten down recently from its highs due to a few reasons. One of the largest being the weight loss reports on the drug Ozempic, in which it claims people are eating less and they're eating healthier. Despite this recent drawback though, Pepsi is still a very strong company. The stock, also like Mondelez, has an impressive brand portfolio in the snack and beverage world. Their biggest snacks such as Doritos, Sun Chips, and drinks like Pepsi and Gatorade are staples in basically every gas station, convenience store, and grocery store in America and in many places around the world. Their brand portfolio is seriously one of the best out there. The company does trade at a high P P when compared to similar companies, but this stock has the stats to make up for it. In addition to their fantastic growth, they have a over 3% yield with an 8.13% 10-year dividend CAGR, which is pretty good and is a sweet way to add to your passive income. The fifth stock I'm going to talk about is Realty Income, ticker O. This stock basically needs no introduction in the stock world, as it is one of the most popular dividend stocks out there, not only because it pays monthly. This stock has been destroyed in the last year, with it being down over 22% year to date, which isn't a good look. This has been caused by many reasons, but the two largest are high interest rates, which harm REITs a ton, as well as a lack of faith in some of Realty's biggest tenants, such as Walgreens. Despite this, the stock does seem to be oversold, with it not really being this cheap since the COVID-19 pandemic, and if COVID cannot kill this company that so heavily relies on retailers, literally nothing can. If you want to learn more about why this stock has done so poorly in a bit more detail, you can click the link on the top pinned comment to watch my in-depth review. Anyways, the stock now yields over 6%, officially making it a really high yielding stock, and the monthly checks are just an added bonus to this. The stock is also a dividend aristocrat with a 10-year CAGR of 4.15%, which is alright, and due to the price drop, it deserves to be on this list as potentially a fantastic value play. The sixth stock on this list is JP Morgan, ticker JPM. Now, this stock isn't necessarily cheap when compared to some of the other stocks on this list, however, I think it is at a pretty nice valuation. JP Morgan Chase is probably the best bank stock in the entire world. They have the biggest market share in the United States, and their recent acquisitions after the brief 2023 financial scare is only going to increase this number. Their leadership under CEO Jamie Dimon is top-notch, and their balance sheet is notoriously as safe as it gets with a fortress balance sheet strategy. This stock, despite being pretty volatile, has gone up 40% in the past 5 years, which is very respectable. Toss in the nearly 3% dividend yield, and this stock is pretty dang good. The 10-year dividend CAGR is 14%, and although the recent hikes have slowed to the crawl, this isn't because JP Morgan is struggling, but it's rather because they would rather play it cautious, which is honestly a good sign for the company if you're looking at it as a long-term investment. This right here is a classic Jamie Dimon play of that fortress balance sheet of making sure that everything is perfect before they give out more money to shareholders. Now, the last stock on this list is very similar to the first one. It is the Home Depot company, ticker HD. Now, on paper, the Home Depot company seems almost identical to Lowe's, but there are some few key differences. Firstly, Home Depot is a much larger company with almost 3 times the market cap. This can be good, but on the other hand, it also can be a problem. It does mean that the company has more cash to grow with, but it also means that growing the business will get more difficult, as when your company gets extremely big, it gets harder and harder to keep expanding, as there is only so much room to grow. The stock, though, like Lowe's, is down tremendously from all-time highs, over 30% so. The company does have a better yield than Lowe's at nearly 3% and a similar PE ratio, but the dividend growth is slightly lower, with the 10-year being over 18% and the most recent hike being 11.16%, which is still pretty great. The payout ratio is still below 50% though, so growth can be expected in this dividend category. Overall, both Home Depot and Lowe's are great stocks, and they're the two best companies in the home improvement business section in my opinion. That is it for this video, and thank you for all who have watched to the end. I hope you agree with some of my picks, and if you do, let me know in the comment section below. If you don't agree with my picks though, let me know as well. I'd love to hear your feedback. I know the reviews of these stocks were very short, but I went over 7 different companies, so I was trying to keep them very short to condense it into a little video. Anyways guys, thank you for helping me hit 600 subs. It's a truly great milestone, and I look forward to continuing to post high quality videos just like this one. Anyways guys, I will see you in the next video. Make sure to like and subscribe if you haven't already, and goodbye.